If you want to enjoy a nice retirement, no matter how distant it appears, while you are still in your 20s or 30s, saving early is one of your best possibilities. It should go without saying that substantial wealth is required to live comfortably. Investing money is one of the finest methods to do this, especially for the working class. Consider this scenario. Assume you decide to invest $500 each month and earn an 8% return. If you start investing at 25 and continue until 60, you will have $2.16 million in retirement. However, if you begin investing at the age of 40 rather than 25, you will only have $341,000. In reality, this easy example is nothing new, and it is based on an investment that generates an 8% compounding annual return before inflation. But for the vast majority of people, this is still the best way to save money and make sure they have a lot of cash on hand to use in hard times. To summarize, beginning early boosts your chance of success. Welcome to Financial Fluence. In this video, I'll teach you some of the most important assets and investment decisions you can make while still young. Let's now get going. Number 1. Index fund stocks. Even though there is a lot of risk, they have some of the best returns before age 40. When you first start out with money, you have plenty of time to make mistakes and learn from them, but you should always make well thought out decisions. Stocks have an average return rate of 10% based on the S&P 500 index as a benchmark. Few investments, in actuality, will provide such a high rate of return. Bonds may be an excellent addition to an index fund strategy. Bonds offer the best level of security but the lowest rate of return. Your portfolio's weighted bond percentage must range between 10% and 20%. As a result, your money is safer. Depending on how much danger you are willing to accept, you may want to lower or increase the proportion. Keep in mind the tax implications while purchasing index funds. Number 2. Real estate. For a multitude of reasons, real estate is one of the best investments. For starters, there is always a housing shortage, and real estate assets almost always increase in value. The first step in real estate investing is to purchase your own home. Owning a home reduces monthly expenses like rent. After you own your own home, you might think about building other commercial properties. Multifamily dwellings, townhouses, offices, and other assets may be included. If you are unable to participate in the real estate market directly, you do have other possibilities. Many crowdsourcing services allow you to invest as little as $500. The money invested would then be put together with money from other investors and used to build real estate. These investments are known as REITs, or real estate investment trusts. Number 3. Education. Statistics show that the optimal age to learn is in your 20s. The best age to learn new talents, according to a study, are in your 20s and early 30s. As a result, now may be the greatest time to earn that additional degree. Education is essential since it can help you flourish at work. You must acknowledge, however, that not all education or learning is useful. If you want to invest in education, search for occupations that fascinate you and have a high chance of success. This could also be an excellent approach to boosting your financial literacy. Number 4. Startup business. Spend your youth making an investment in a startup company. Why? Owning a business has countless advantages. You'll be able to generate as much income as you possibly can, with an unlimited ROI. Another investment you should make in your 20s is a startup business. An amazing high ROI is a possibility. Investing in a nascent business can produce spectacular results, even if it isn't the next Amazon. Starting your own business is not always necessary. You can invest in other people's businesses in exchange for stock. Being an angel investor is a good alternative if you know the entrepreneur. You can contribute in the form of a convertible note, which can be converted into a loan if certain conditions are met. Number 5. Treasury Bills. Treasury bills are an important investment for all investors of any age. There is no better moment than the present to invest in Treasury bills. Treasury bills are short-term debt instruments backed by the government that are used to pay for spending and control the money supply. Treasury notes have maturities of 90, 182, and 364 days. Tuition, rent, and even professional exams are all required expenditures. Treasury bills are straightforward to buy and sell when they mature. This is an example of asset and liability matching financing, in which an asset is purchased to pay for a future obligation. Unlike other investing options, Treasury notes are completely risk-free, so your profits are assured. And before we continue, don't forget to subscribe to the channel, hit the like button, and turn on the notification bell to be notified every time a new video is uploaded. Let's return to the video now. Number 6. Growth stocks and dividend stocks. We've already established that being in your 20s and 30s is an excellent time to take risks because you have more time to recover your losses. Thus, investing in stocks is a good way to invest some of your money in a high-risk, high-reward venture. The sector average is likely to beat growth stocks. In terms of long-term cash flows and revenues, these stocks beat their peers. Dividend stocks, on the other hand, are often equities from financially stable and mature companies that have lower volatility than growth stocks. It should be included in your portfolio from the start. Businesses that are efficiently handled can generate a consistent income for a long time. Number 7. Exchange-traded funds. Let's take a look at ETFs as an alternative to the index funds we discussed previously. ETFs, like index funds, are securities baskets composed of a variety of assets, such as equities, bonds, and gold. Shares can be bought and sold on a market, and they trade similarly to stocks. Because of their versatility, they are good tools for investing in large market indices like the S&P 500, sectors like technology or health, and even sub-industries like social media or robotics. Number 8. Commodities in economics. A commodity is an economic good, usually a resource, that can be used in many different ways. This means that the market treats all examples of the product as the same or very similar, no matter who made them. There are various options for investing in this. The first stage involves acquiring various genuine raw resources, such as expensive gold bullion. Investors can also acquire futures contracts or exchange-traded products, or ETPs, that directly track a commodities index. These are high-risk, complex investments that should only be undertaken by seasoned investors. Mutual funds that invest in commodity-related firms are another way to gain commodity exposure. For example, an oil and gas fund might buy stocks from companies that look for oil and gas, refine it, store it, and sell it. Commodities investing provides portfolio diversification, potential rewards, and an inflation hedge. Number 9. Annuities. An annuity is a contract between you and an insurance company that guarantees you monthly payments in the future or right now. An annuity can be purchased in either a lump sum or in installments. Some annuity options allow you to save for retirement. Others can help you turn your money into a retirement income stream. Others, though, do both. You have a deferred annuity if you use an annuity as a savings vehicle, and the insurance company delays your payout until the future. The two most common forms are fixed and variable annuities. An index annuity is a mix of a fixed index annuity and an equity index annuity. Investors often think about annuities when planning for retirement, so it's important to know where they are. They are also widely promoted as tax-free savings vehicles. Fees and costs for an annuity include surrender charges, mortality and expense risk charges, and administration fees. Number 10. Cryptocurrencies and initial coin offerings. Only recently have traditional Main Street investors begun to show interest in cryptocurrencies and initial coin offerings, or ICOs. There are more than 1,000 different cryptocurrencies available right now, and billions of dollars have been put into initial coin offerings to fund startups. Most average investors find it hard to understand these complicated investments and figure out how risky they are. We do, however, know that they have extraordinarily high returns. The potential rewards are between 12% and 200%. ICOs have sometimes done incredibly well. For instance, the OTA had a 13,000 time return on investment. In other words, if you had invested $1 when it was given, you would have made $13,000. And that's all. I hope you enjoyed this video. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell, and I'll see you in the next video.